Effect on non-controlling interests when there's intra-group sales and purchases of inventories. When we are attributing the equity of the subsidiary to non-controlling interests, either the opening balances or the current year movements, you have to decide whether the TB amounts of A's, being your starting point, have to be adjusted for the effect of consolidation journal entries before an amount is attributed to NCI. Remember here the principles from Chapter 4. In Chapter 4, we had two questions to answer. The first question was, does the group's equity or profit, we're only really focused on the profit there, change as a result of the consolidation journal entry? Only when the equity or profit of the group change can we also change the equity attributable to NCI. So if your answer to question 1 was yes, the second question was, are we changing the equity or profit of A's that is included in the consolidated numbers? And the reason we have to ask that is because NCI depends on the trial balance amounts of A's. If a consolidation journal entry is changing the trial balance amounts of A's that ends up in the consolidated numbers, you have to change those trial balance numbers of A's before attributing to NCI. So if your answer to both questions above is yes, NCI will be affected. Let's now apply this principle to the 3 journal entries we've looked at so far in Chapter 5. The consolidation journal entry to eliminate total revenue and purchases. Does this journal entry change the group's profit? I have a debit to revenue and a credit to cost of sales. They are both profit and loss accounts for the same amount, and my answer is no. So the effect of this consolidation journal entry should not be considered when calculating profit attributable to NCI. The consolidation journal entry to eliminate unrealized profit in closing inventories. Does this journal entry change the group's profit? I have a debit to cost of sales and a credit to inventories. Only the debit is a profit and loss account. So my answer is yes. It's the main purpose why I'm writing this consolidation journal entry. I'm debiting cost of sales to reduce the group's gross profit. Second question, whose profit am I changing for purposes of changing the group's profit? And only if the selling entity is the subsidiary, would you consider the effect of this consolidation journal entry when calculating profit attributable to NCI? If the parent was the selling entity, it's the parent's gross profit we're changing for purposes of changing the group profit. If the subsidiary was the selling entity, you would change the subsidiary's gross profit for purposes of changing the group's profit. So when you take the TB profit of S, you would first have to adjust it for this journal entry if S made a profit from selling to P before calculating profit attributable to NCI. The consolidation journal entry to eliminate unrealized profit in opening inventories. Does this journal entry change group profit? Yes, it does, because only the credit leg is a profit and loss account. Again, it is very important to know who the selling entity is. Only if the selling entity is S would you change the profit of S with the effect of this journal before calculating profit attributable to NCI. And then, if you are changing the retained earnings opening balance of S with this consolidation journal entry, You would also have to consider this when calculating the portion of opening retained earnings attributable to NCI. It now becomes very important to know who the selling entity is, who the entity is that made the profit. Only when the subsidiary is the selling entity would the TB numbers of the subsidiary be changed with the effect of your consolidation journal entries before you calculate profit or equity attributable to NCI.